we have, GDP numbers. It is a big week in many other ways as well. Let's invite a big industry honcho to inaugurate Bazaar. KK Mistry, the Vice Chairman and CEO of HDFC, joins us on the show now. Good morning, Mr. Mistry. It's always good to have you with us. Well, first, let me dispose of the smaller news that came in small for you. SEBI has increased the limits up to which mutual funds can take positions in housing finance companies. Is that a big deal for you at all? Will that make money a little cheaper for you?
I don't know whether it makes money cheaper. It can make money a little cheaper, but more important than making money cheaper, it increases the avenue of funding that will be available to housing finance companies. So the earlier limit that SEBI had was that the total exposure that they could have could be totally 35%, 25% for the financial sector, an additional 10% for housing finance companies, which have a certain rating, a minimum certain rating. Now that 25% remains 25%, but the additional 10% has been raised to 15%. So technically, theoretically, it can mean that up to 40% of the funds can be invested with housing finance companies. So it does open up the pool of funds. If you look at the total amount of funds that are lying with debt funds today, the amount would be about 12 lakh crores or around 12 lakh crores. If you take 5% additional of 12 lakh crores, it's about 50 to 60,000 crores.
Mr. Mistry, good morning. What about the cost of money? We have seen yields shoot up after the monetary policy. Will margins get crunched?
Margins won't get crunched. We have always historically over the years, if you look at our margins every year, our margins have remained fairly stable and they will continue to remain stable. Margins went up a lot in the third quarter, specifically in the third quarter. But because we have reduced our lending rates post the third quarter, margins will come back to the normal range of around 2.3 to 2.3, well, 2.25 to 2.35% for the year as a whole.
Okay, so that's steady. Is there scope for rates, both lending and borrowing rates, to fall at all? Or do you think we have troughed out as far as rate cuts are concerned?
Well, I think the bulk of the reduction has already taken place. So if you look at home loan rates compared to where they were 6 or 8 months ago, rates are down by anything from 60 to 80, 60 to 90 basis points. I would say 60 to 80 basis points. So rates have come down in a huge way. So whatever was the backlog, whatever cut in rates had not happened in the past, all happened in 1st of January. Now, any further cut in rates, to my mind, will depend upon what RBI comes out in its future credit policies. Will RBI cut rates in future? It is envisageable. It is, I think, data dependent. RBI is going to look at what the outlook on monsoons will be. RBI will look at what comments come from the Fed. RBI will look at what happens to oil prices and then take a call on whether they should look at further reduction in interest rates. But the big part of the cut in rates has already happened. But Lata, we need to understand that rates have come down. If you compare home loan rates, or why even home loan rates, take any rates in the system, they are significantly lower compared to what they have been in the last 7 to 8 years.
Okay, so Mr. Mistry, you would think that this year itself you would be at normal loan growth rate, or will it take next year for growth to return to the secular rate?
I mean, if you saw the 9 monthly figures, I'm sure you'd have seen that the individual loan book growth was around 60% for the 9-month period. Our guidance historically has been with a long-term view of 15 to 18% growth. So we were well within that guidance.
Well, finally, it's a big week. We're going to get GDP numbers tomorrow evening. Do you think the economy is on a recovery path at all? Or is that recovery probably a couple of quarters away?
No, I would certainly believe the economy is on a recovery path. The only thing is if you see all the macro data all looks very nice. Current account deficit, fiscal deficit, inflation, well, there may be signs of some pressure on inflation over a period of time because of global events like oil prices and stuff like that. But all the macro numbers in India today look very, very good. The only thing we have to really get going is to pick up in the investment cycle, private sector investment cycle. And that, to my mind, has been slow only because of the fact that over time, businessmen have created excess capacity. So today, businessmen have the capacity to produce more than what they are doing presently. So if you have that capacity to produce more, you don't create new capacity, you don't start a new plant and machinery, you don't start a new factory, you hold on. To get the consumption, to get the capacity utilization figure higher, we need to have higher consumption. Higher consumption generally happens when there is more money in the hands of people. So I would think that we are probably still 2-3 quarters away from really seeing a pickup in the private sector investment cycle, but we are not that far away from a time when we will see that happening. But if you leave aside the investment cycle, I think everything else in the economy is doing well. I again repeat that these tax benefits or the subsidy that has been provided by the government to the housing sector will actually kickstart in a big way the entire economic cycle. So housing is a huge employment generator. Construction workers, plumbers, masons, carpenters, and so on and so forth. And more importantly, housing also supports a whole host of other big industries like cement, steel, paint. So if the housing sector gets a boost, which I expect will happen, then all these core sectors in the economy will also get a boost.
All right, we're waiting for that. Let's see what the numbers tell us tomorrow. Mr. Mistry, pleasure speaking with you. Thank you very much for joining us this morning. Have a great day. Well, let's take a quick break. We are